Hello and welcome to another exciting episode. For you to have been here, it means you must have seen some of our videos on various courses. Today, I will be taking us through something that we must have come across, but we don't understand what that thing is all about. And this is what we call smart money concept trading. Okay, smart money concept. You'll be like, oh, I've heard this thing before. Yes, that's true. You must have come across it before. So, as a student of price action trading strategy, if you have not seen the video, you can go ahead and watch a video on price action trading. If you are a student of price action trading, you trade using price action. That is, you read and understand what price is saying. Okay, it is going to be an exciting strategy for you to pick up when we talk about SMC. Okay, because price action is like the father of SMC. Okay, everything that smart money concept talks about is still rooted into understanding what your price is saying, reading price, trying to create a story, write a story about what price is saying, what your chart is saying, interpreting them without relying on any external indicator. Okay, so we commonly say trading smart money concept is like trading like the banks or trading like the institutions. Okay, smart money concept is a strategy designed towards following the trails of the institution. If you look at your chart and you're able to understand what price is saying, you discover that these institutions, they leave behind trails for you to follow. And this is why we call ourselves, traders that try to trade like the banks or like the institutions. So these institutions we are talking about, what do they target? They target liquidity. Liquidity moves the market. Liquidity can be seen as an attraction of price. Price moves towards where there's liquidity. So if you're looking at your chart, wherever liquidity is lying, that is where you see price heading towards. Okay, so now let's try to break down the components, or let's say the frameworks of what smart money concept is all about. The first thing is structure. Okay, understanding your break of structure. Do we have a break of structure to the upside or to the downside? Which means for you to understand your break of structure, you must have understood how to even mark your structure. So if you have not, or let's say if you're still struggling with the understanding of structure, I'll still refer you back to one of our videos titled Price Action Trading. There, we explained how to mark your structure correctly. Okay. Now, the second thing when it comes to SMC is your POI. When I say POI, it means point of interest. Okay. Where is your interest lying when you are looking at a particular currency pair? Okay. That zone where you are eyeing to take a buy or to take a sell, that is your point of interest. Okay, and this point of interest can be seen in two different formats. That is your demand and your supply. Okay, it's either you have a demand zone or a supply zone. A demand zone where you are willing to buy from, and then the supply zone where you are willing or hoping to sell from. Okay, and the third thing is the whole B. Within that your POI, within that your demand or supply, you must have an order block. Okay, and what do we regard to as order block? For a bullish OB, a bullish order block, that is the last sell candle before an impulsive move to the upside. The last sell candle before an impulsive move to the upside, that is the bullish OB. A bearish order block, that is the last buy candle before an impulsive move to the downside. Okay, so if you are looking at a chart like this, and you want to pick your order block from this swing low, it is the last sell candle here that will tell you, okay, that is what you pick as your order block for a bullish OB. The last sell candle within the swing low before that impulsive move that went ahead and did a break of structure. That is what you regard to as your bullish OB. Okay, and for your bearish OB, you say the last buy candle. You can have this as well. So from inside of here, this zone, you have your POI, but inside is your POI, which is your supply. You know, this is a sell, which means you have your supply here. So from inside this supply zone, there must be a buy candle, a particular buy candle before this impulsive move to the downside. So that will be your bearish order block. Okay. So the next thing is liquidity sweep and manipulation. Okay. Now, if you have a move like this, the swing low that you are looking at, the low that was responsible for a break of structure to the upside, or the high that was responsible for a break of structure to the downside, it's either this low or this high. Either of them, whether you're looking at the low in a bullish structure or the high in a bearish structure, they must have swept a particular low. For a buy now, this must have swept something here, a particular low, or you call it manipulation, or you call it liquidity grab, whatever name you give to it. And this high too must have swept something, which is a form of liquidity grab. That is, this low grabbed liquidity, so that when price is trying to come back to this zone where you hope to take a buy from this demand, you will not be taken out because liquidity has already been taken. So this low already swept liquidity. The same thing here, if price is trying to approach this your supply, since this high had already manipulated something, price will respect that supply and then keep going lower. So that is why for a particular swing low that you are hoping to take a buy from, where you mark your demand POI, or a particular high where you're hoping to sell from, where you mark the supply POI, they must have swept liquidity. They must have manipulated something. Okay? And the next thing is you must have an inducement. Okay? As price is approaching that your POI, it must also take liquidity before it gets to that POI. Else, your POI, that your demand will be liquidity to sweep, to sponsor a buy or to sponsor a sell. So if you are buying, if you are trying to take a buy, you don't just want price to come right into your POI without inducement, because price will kind of take it out and then you see a move to the upside. Okay, but once you have something like this, you can take this low as inducement, then you mark this your order block. Price will now take this inducement as liquidity, tap into your demand POI, and then it buys to the upside. The same thing with sell. So you must have an inducement. Remember, liquidity is an attraction of price. So once price takes that liquidity and it gets to your demand or your supply POI, then it will move in your intended direction. And lastly, you must have liquidity as target. Okay? Price moves towards liquidity. So if you want to take a buy, there must actually be a buy side liquidity to target. And if you're selling, there must be a sell side liquidity to target. So there are different types of liquidity. It can be equal highs or equal lows. It can be hold highs, hold lows. Hold highs in the sense that if structure is bullish, if you have a bullish structure, the lows are always protected. Alright? While the highs will always be cleared. Okay? So as price approach this zone now, you want to take a buy from here, you target the hold high. This is the last hold high. You target that and price will take it out. So we'll call them hold highs or weak highs in a bullish structure. And if it's a bearish structure as well, let's say you are trying to take a sell from here now, price is coming back and touch here, you will target this next low because this is the hold low, or you call it weak low. In a bearish market, the highs are always protected while the lows get taken. They are weak lows. So that is the approach to that liquidity. So sometimes it might also be equal highs and equal lows. Sometimes it might be trend line liquidity. So where you have a trend line like this, coupled with numerous touches, you already have many tests, retest of that trend line. The trend line has been tested so many times. Price will manipulate it before eventually, going to the upside. Yes, you are right to look for buy, but a retail trader now will still keep trying to take a buy from this trend line. Boy, it has been tested too many times. So which is liquidity for price. So the big banks, the big boys, the banks, the institution, they will try and manipulate this before they now eventually go to the upside, because liquidity is an attraction of price. So price got attracted to this liquidity first. He took out that liquidity before he now went ahead to take these highs and whatever other liquidity we have on the buy side. So the closest liquidity is what price is going to take first, is what is going to manipulate first. So this is the closest liquidity in view. So price took the sell side liquidity. This is the sell side liquidity before it will go ahead to target the buy side liquidity. So whenever you are trying to work with a smart money concept, all of this must be present in your setup. You must have your break of structure. Your break of structure should be in direction of that market trend. That is, you should look for more of continuation. If your trend is bullish, try to look for a break of structure in that direction. If our price is going to change from a bullish to bearish, all right, you must see a clear break of structure on higher time frame. Okay, the break of structure should be on higher time frame. So you must trade in direction of that break of structure. If you have a break of structure to the upside, it means you look for your buys. And if you have a break of structure to the downside, you look for your sell. Okay, so now let's look at a simple framework that I marked here. So this is a bearish structure here. These red lines, you could see that we kept creating lower highs, lower lows. We had this high, broke this low to create a lower low, lower high, broke this low to create a lower low, right? Lower high again, broke this low to create a lower low. Lower high, another lower high, broke this low to create a lower low, right? So as price is coming back to approach this zone, remember you want to take a sell from here. It failed, which means this is the point where we have what we call a break of structure. So let's label that break of structure. Break of structure. Let's use this. So this is a break of structure. So it means what we see before as a break of structure here, right, to the downside to create a lower low, it will not be tagged a break of structure again. It means price just swept liquidity. That is what we call liquidity sweep. Okay, so let's write a break of structure here. BOS. Why this? You can put liquidity sweep, liquidity grab, stop on, whatever name you want to give to it. So let's say LG, liquidity grab. Okay, now if you look at this, we already have a break of structure to the upside. If you look at what we listed before, what are the things we should have? Break of structure, right? We should mark our POI, our demand or supply. We should find our order block. There must be liquidity sweep, inducement, and liquidity as targets. Now, let's go back here. We already have our break of structure. We have our liquidity sweep, right? The next thing is for us to have our POI. It means the swing low that was responsible for that break of structure, that will be where your demand is, right? Inside that demand now, you will now look for an order block inside. There must be an order block. Let's say the last sell candle, because remember, this is a bearish. We want to look for a bullish OB, and a bullish OB will be the last sell candle before a move was seen to the upside, before this impulsive move. So it means this is where we will mark as our entry. The body of that candle, that is where we'll mark our entry and our stop loss here. Okay, let's look at other thing we have. We also have inducement. This low will be seen as our inducement. That is, it's going to be like a liquidity when price is trying to come here and approach our demand. So let's write demand inside of here. This is our demand. Let's put demand inside of that. So this is our demand zone. Okay, we have our inducement, our break of structure, which means this structure that was initially bearish is now bullish because we now have higher high being created. Okay, we have a break of structure, manipulation, liquidity grab, liquidity sweep, stop on, whatever name you want to give to it. We have our demand, and inside that demand we already have our order block. Remember, this red candle, we see it as our order block, the last sell candle before an impulsive move to the upside. Then we have our inducement. So the next thing is for me to set an entry here. You pick your buy tool, our entry by this our order block. Remember, we use this red line to mark the body of the order block. Then your stop loss, don't use the body of the order block as your stop loss. The swing low. Do you know the reason why we pick the swing low? Because once price is bullish, the lows are going to be protected while the highs are going to be weak. They are going to be a target. So the big banks, this is also why we say we trade like the institution. The institution will keep giving us trails that yes, I want to start buying now. The trail is this break of structure. The trail is the protection of this low. When price was selling initially, you could see that all these lows, all these highs, they were protected. They were not broken until they got tired or they ran out of juice to keep selling. Then the buyers came into play. So buyers too, they will keep protecting their position. The lows, the major swing lows that led to a break of structure, they will be protected. Okay, so now you should note something, that you must always have this framework for buy or for sell. Whenever you are trading, it must always be like this, or that's for buy, or like this for sell. Okay, sorry, let me draw that again. You must always have that framework for sell. This one for sell and this one for buy. So either of the two. This will be your inducement. You find your supply here, and then you target liquidity. This will be your inducement. You find your demand here, and then you target the next high. Okay, so you must always have this swing move, retracement, another move. Okay, swing move, this impulse move, retracement, and another impulse move. Impulse move to the downside, retracement, and another impulse move. So you must have this. That is when you can now try to look for other things. If there's anything missing, you shouldn't take that trade. If you look at this, we have our break of structure, which is the first and fundamental thing. Then the swing low that was responsible for that break of structure, it actually grabbed liquidity. Initially, when you were selling, marking this sell structure, remember you take this as a break of structure. But once a break of structure goes to the other side, it means that former break of structure will not be regarded as a break of structure. It was only a liquidity grab. That price just grabbed liquidity, okay, manipulated those that will continue to sell, and then decide to go to the other direction. Then we take this low as our inducement. So that if price is now approaching here like this, if price starts coming to the downside, it will take this inducement as liquidity. Remember, liquidity is an attraction of price. So price was attracted to this liquidity. Once price takes liquidity on that sell side, the next thing is to go to the buy side. Alright? So then it gets to our demand POI, and we expect it to continue to the upside. So your target will be probably the next swing high that was created. Let's say this was the last high while price was selling. Okay, you can target that. Or let's say price created an equal high before. Let's say you have an equal high like this. You can target that also as your take profit. Then if you look at it, at least you must have a minimum of like 1 to 3 weeks reward, 1 to 4 weeks reward, depending on your strategy. So this is how we look at a buy setup, a buy framework when it comes to SMC. And if we should invert the charts now, the same can be said for a sell. So we had a buy before, price was going to the upside, and suddenly we saw a break of structure to the downside. So this will no longer be a demand, we'll call it a supply. So you can save this framework, this picture. This should be exactly what you are looking for. So once this continues, let me remove this. What you expect now is that if price eventually respects this, price went up, respect this, and then we now started selling again, you can continue to look for another opportunity. Then price broke this, you created this again. This is another framework. Look at it. There was a break of structure to the downside. Price has given you another inducement. Then you look for another supply. You mark another supply. Price will come back here, and then you continue your sell in the direction of your structure. That is how you keep looking for entry until probably there is another break of structure to the opposite direction. Then we'll mark another demand, hope that price will come down and then go up again. So that is just the simple approach to trading smart money concept. Price will always give you that hint. The banks, they will leave trails so that you can know where they are heading to next. Okay, wait for price to come to you before you are going to take your position. Don't chase the price, wait patiently. All right, so that is the framework. Now let's go and see a chart example. Let's see if we can find something related on the chart. Let's look at the last move that happened here. This last move that happened here, this low, right, broke this particular high. We had a break of structure here, right? So we can confirm a break of structure. So this is the recent structure that we are working with. This low, let me just use this, and then up until this highest point that price got to. Okay, we broke this. Now, if you look at this low, remember we said there must actually be liquidity sweep. Did it take a particular low? Yes. You could see that there was a sweep of these lows. This one right here, this one, there was a sweep. Okay, and then we had a break of structure to the upside. Now, the next thing is, do we have an inducement? Yes, there was an inducement. Let's see how price moved. This was the first main bullish buy to the upside, the first buy to the upside, the first swing buy. Okay, before we saw a major pullback and then a final swing move. Okay, so this is what happened. The first swing buy, the first major pullback before another buy, which means this low is our inducement. This low is our inducement. So let's label it as inducement, right? This plays as our stop hunt or liquidity grab. Then we have our break of structure as well. This is our break of structure. Okay, so now it means somewhere inside of this swing leg, that is where our demand is. Okay, this is our demand. So it is now left for us to look for, let me switch to 4-hour time frame, to look for the other block that we can use. That is the last sell candle before the buy. So this, let's pick the last sell candle. This was the last sell candle. I don't want us to refine the entry too much. So that was the last sell candle before the impulsive move to the upside. So it means we identified our demand, then we pick the other block inside of that demand. So this was the last sell candle before the impulsive move. So for us to buy now, you set your buy entry by that other block, right? Buy, and then our stop loss here. Remember, our liquidity target, price has taken this inducement as liquidity on the sell side. Then our target will be this last swing high. You can see an equal high here. Price created an equal high here. You can see that's a target, a liquidity target. So you can put something like this to signify that. I have dollar sign. So it signifies that this is my liquidity target. Then I target this place. This is actually a current running trade. I have a position running on this trade now. So then you're in the trade. That is just as simple as it is. Look at the framework: a swing move, an inducement, then a final swing move that led to the break of this last high, which confirmed to us that we have a break of structure to the upside. And if you actually want to take a swing trade, you can decide to target the last major high that was created. Okay, but you don't need that. Just this is enough. This is 1 to 4.62 RR already, risk to reward. So this is a very clean trade for buy. We should invert the chart. You see the same for sell. It's the same thing. If it happens in the opposite direction, that's the same thing you take. Liquidity sweep, break of structure to the downside, you have your inducement, and you enter your trade. Okay, now what we see as liquidity grab here, for someone, for me that I'm just analyzing this, I will see this as inducement. Okay, but let's say this trade has played out now. Price went ahead and break structure to the upside. This, if I'm just analyzing, I'm just coming, I was not involved in this trade. This inducement, I will mark it as what? As a liquidity grab. So an inducement that has been manipulated is what we call that liquidity grab, stop hunt, or whatever. This low, it was an inducement into an other block here. Okay, there will be, if you go to the lower time frame, you discover that there is another block here that price actually respected. So price took this inducement, touched the other block, and then started buying. So for someone that was not involved in the trade, it will mark this as liquidity grab. But let's say I took a trade from here, I will mark this as inducement before. For me, I will say, oh, it's an inducement into my other block, then I took a buy from here. That's for me that I was present when price was not there yet. Then I'll target this high as my take profit. So it is an inducement to me. But for someone that is coming again to take this trade, the person will not mark it as inducement. Will mark it as stop hunt or liquidity grab. You get it now? So that is how the concept of inducement and liquidity grab or stop hunt works. They are the same thing. An inducement that has been manipulated. After a manipulation of a particular low, that is when you call it a stop hunt or a manipulation or liquidity grab, whatever name you decide to give to it. Okay, so it's still the same concept. So for your buy or your sell to work, you must have a break of structure, a sweep of liquidity, an inducement, okay, and the liquidity to target, and that is all. And you must always look to trade in the direction of your structure. This my structure is bullish. It will not be ideal for me to now start looking for sell here because I have another block here. Oh, this is a bearish other block. Then I want to start selling. Because there is no break of structure to the downside. So always trade in the direction of your structure. Okay. For more understanding of structure and some other related topics when it comes to smart money concept, you can sign up for more advanced courses and topics into what SMC is all about. We have a whole packaged SMC course. But if you also try to backtest this, I believe you are going to make moves in the market, trading the smart money concept. So working towards the trails and liquidities that price is printing, that is what we mean by trading like the banks, okay? Trading like the institutions. So once you trade towards their direction, you don't have anything to fear. Then you will start eating TPs, more of TPs rather than stop loss. So see you in the next video. Thank you and God bless.